presentation contains current opinions of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that those opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation.
Hello, everyone, and welcome to the Compact Market Wrap Update for July the 20th, 2026. I'm Moe Javaid, joined by Javaid Ansari, Executive Vice President here at Compact, and thank you for joining us today. First of all, a housekeeping note, don't forget to subscribe to this channel so whenever we post an update, you'll be notified and you can watch it at your convenience. Also, if you need help with your portfolio, send us an email at compact.com or give us a call at 800-388-9700. Javaid, let's talk also about the book. Very exciting. Feiroz's book is coming out. It came out on the 14th, as a matter of fact.
Yeah,
Tell us a little bit about it.
Yeah, the Wisdom and Wealth Solution. It's available for distribution now. If you want to go on Amazon or wherever you get your books, it's available. So Feiroz we're having a wonderful UCI launch event here this Wednesday, and we'll be doing a lot of different content creation around Wisdom and Wealth Solution here over the next couple of months. And so just would invite everyone. Gotten great feedback from clients who've already ordered it, and I've been talking about Wisdom and Wealth with clients for years, but now to have it in the book form and available. And I really enjoy the book because it has a lot of, I think, just great stories that Feiroz, it has incredible information, and that's the core of the book. But also the stories are very relatable in terms of, how do you apply expanding your wisdom, whether it be religion, politics, genetics, free will, some of these core pieces that Feiroz has really distilled to really kind of engineer what is a kind of wisdom or very wise type of life, but then also coupling that with financial wealth and really the core tenets of what are the really good ways to create financial wealth. And so a lot of my clients, they've purchased it not only for themselves, but particularly for the next generation, because I think it really does resonate with the next generation in terms of providing some great information.
And so we have an event coming up, and we have a new YouTube channel that all of you can go to and learn more about wisdom and wealth. I think it's really one of the foundations of life. How do we spend all our lives creating wealth? That's a lot of us are trying to figure out where to get comfortable, where you have financial security, how can we take care of our family, our kids, and all of those things. And it really sort of synthesizes all of that. It's a very concise sort of way of looking at all of those things and putting it together, life and wealth. How to use wealth to make a life better and how to make your life better with wealth. That's really what it's all about. And we have this new YouTube channel. Imran is helping Feiroz with it. And the first 2 episodes are available, I believe.
Yeah, so you just go on YouTube, just type in Wisdom and Wealth Solution, it'll pop right up. You'll see, and once again, we're giving different media formats. Not everyone, of course, is going to sit down and read a book, even though I think the book is incredible, once again, with all of those stories. But given the modern age, there's an audio book as well as the YouTube kind of distills a lot of the core pieces of the book, and Feiroz is the one who's directly presenting all of those concepts on the YouTube channel. So definitely give that a listen to if you're interested. But more importantly, go out and order the book. It's I think a well worth investment, not only for yourself but for your family.
Okay, let's get back to the markets.
Yep.
A little shaky here, aren't they?
Yeah, well, we've seen a pullback over the last couple of weeks. The S&P down 1.55% last week, Dow down 0.93%, Russell down 0.5%, so relatively kind of outperforming last week. But I was looking still at that Russell number. I know I'm still kind of bearish on the Russell. It's up 20% year to date. It's almost doubled the S&P. Yet it's down 2% for the quarter, so showing a little bit of kind of relative weakness there. But really the story is growth. Growth down 3.64%. Emerging markets, which is kind of, they've gotten really kind of top heavy with growth in terms of the semiconductor stocks in the emerging market index. That was down 4.1. NASDAQ down 2.9. EFA holding up relatively well at 0.81. So I think we're just kind of still kind of seeing some corrections. Clearly the big news last week was also the re-escalation, I think, within the Strait of Hormuz with the US-Iranian conflict. That's causing kind of interest rates to remain a little bit higher, even though we got some good CPI data. We'll unpack all of that. But I think it's all about earnings now. We're in the heart of earnings. We're going to get a lot of earnings. I think Google's on Wednesday. The banks reported last week really good earnings for the banks. Whenever there's a lot of IPOs, banks are going to do well because they're underwriting all of those IPOs. But really want to see how the tech companies. I think their earnings are going to be good. But it's going to be what their guidance is all about. The market is really based upon right now this future AI investment for it to continue. And are they going to continue to guide higher in terms of those capital expenditures going forward? And I think that the market's starting to kind of say, you know what, we might need to hedge these kind of little bit of elevated prices a little bit, just in case they might start pulling back. And we have a really good chart in the YouTube.
The question is, they're making this investment. Are they going to get a ROI, return on investment? That's what I look for. And I think that's all these hundreds of billions of dollars that are being spent on building these data centers, buying all these chips, doing all of this stuff, which is wonderful because it's tremendous for growth. But at some point, when you're spending money, you want a return on that investment.
Well, and the market is very transparent about they're expecting the return on that investment to happen by the end of 2027, 2028. So the monetization of AI, all this build out around AI, it needs to start happening relatively soon. The market's always looking forward around 6 to 12 months. So there really needs to be a really strong pathway to monetization of AI. And Anthropic now is really kind of pivoted more commercial and defense, right? They had a little bit of hiccup with defense there for a while, but have kind of cleared that up with the administration, who's now regulating a lot of these frontier models. But I think Anthropic is one, but OpenAI is probably the biggest one. And OpenAI is a lot. I was looking at a chart the other day of looking at their market share since they launched in 2023. They had like 80% of the AI market. OpenAI did. Now it's down to 50. And the main contributors that have eaten into that market share have been Google, Gemini, DeepSeek, actually Chinese OpenAI, open-weighted AI models, and Anthropic. Those are really the three that have really bitten into the market share of OpenAI. And now people are kind of questioning whether OpenAI should go public or not, especially now. Everyone was super excited about SpaceX, right?
Well, it's below the IPO price now.
Yeah, so I think I was looking at it today. I think it was down to 120. I'm kind of looking at SpaceX. I was asking some of my analysts, what's the fair market price? They're like, we have no idea with how the multiples it's trading at. But some smart people in the room are saying around 90 is maybe a level to kind of take a look at SpaceX. I don't know. It's just really hard to give any sort of fair market value on something that's not generating any return. It's all speculative about the future. And I think SpaceX is going to be around. They're the biggest game in town. But when you kind of get these really kind of nebulous type of business models, not nebulous, but it's just haven't been proven, that's your recipe for some speculation.
Everybody's buying it. I think it's another Tesla that is going to come back and make money, and which I think it will. I believe that SpaceX in the long term, short term is going to be very, very volatile, just like Tesla was. I mean, it went up 50%, down 50%, and that's the kind of thing that can happen. But SpaceX, I think technology-wise, is way ahead of everybody else. They are launching rockets, and they've got their big rocket going off. It was supposed to go off Friday, but it didn't, and they're going to run another test on it. And once they get successful with that, that'll increase capacity dramatically from their Falcon 9.
And it's just, I think we look at some of these charts, particularly these numbers year to date, and look at value stocks. Value stocks are up 19%. Growth stocks are up 1% year to date. And so I think that's the key thing I want market wrap listeners to take it from, is that now is probably not the best time to be doubling down on all of this exciting growth AI. The money to be made, particularly around, let's say, SpaceX, was actually 10 years ago when the VC guys got into SpaceX. They just got out. And they're going to be continually getting out as there's more shares coming to market over the next 6 to 12 months. Same with OpenAI, same with Anthropic. And so the market is even telling us, we're kind of not as bullish on growth. We've shifted more towards value, which is positive. It's also shifted towards the Russell 2000. So economically, things are still headed, I think, in the right direction. But if you're kind of investing of where the ball's already been, you tend to maybe miss a goal here. Just to
The
give you
train
a
is
little-
left as far as that station,
Exactly.
that train is concerned. Now you're chasing it down the street. That's the way I would put it, and you don't want to be the one when the train has already left the station, and then you're trying to chase it. It's not a pretty picture when that happens. Energy back up 5% for the week. I think it's the re-acceleration of the war with Iran, and it's just not seemed coming to an end. I thought the MOU would end it, but it's not ended. It reminded me of what Johnson said, Lyndon Johnson, about the Vietnam War. He says, seems like it's a Texas thunderstorm. I can't run from it, I can't hide from it, and I can't end it. So that's what he said about the Vietnam War. It dates me a little bit, but it reminded me of his saying, and that's really the whole situation with this Iran war. It's just not ending, and doesn't seem like there's any end in sight or an exit strategy out of it one way or the other. So either we escalate dramatically, send in troops, and that increases casualties.
I think there's only two ways it goes away.
Okay.
One, we have to now at this point, because the Iranians know that they have a stranglehold over the Strait of Hormuz, the U.S. or allies is going to have to pay them hundreds of billions of dollars to compensate them for the damages and basically to reinstate kind of all of the lost oil revenue. So we're talking 100, 200, 300 billion. 300 billion was in the MOU, but the Iranians are saying that's all great, but we want to show us the money. Going back to Jerry Maguire, and so I think until that actually happens, they're going to continue to they'll say, hey, we got a deal, but if you don't show them the money, they're going to then start to disrupt things again, because that's the only leverage they have.
But in the long term, that just creates a much stronger Iran, and they basically control the Gulf.
That ship has sailed. I mean, if they control the Gulf, you've given them that power.
The Straits of
If
Hormuz,
you really, then I think the other option, right? So that I don't think that's a good option, but that's kind of you're creating a situation in the Middle East, probably in perpetuity now.
Right.
But it kind of it opens the Strait of Hormuz, brings down oil prices, puts it on the back page instead of the front page in terms of the news. Long term, who knows in the long term what happens. And then the other piece is to double down and actually send in troops and actually do a regime change and have a revolutionary type of war within Iran that's going to be, hundreds of troops are going to be killed. But then you're actually creating a stronghold, in the Middle East for the long term. But I just don't think there's any sort of political will or even public will for that type of move at this juncture, just given how people are already so kind of dissatisfied with how it's played out so far. So I think it's going to be an ongoing thing. The impact of it on the markets is interest rates. The 10-year Treasury, we got very weak CPI or disinflation, pretty good CPI numbers last week.
But interest rates did not go down.
But interest rates did not go down, and the reason they're not going down is because oil is coming right back. And so, interest rates I'm watching, if they're going up just because it's a short oil shock, I still think that's an opportunity to buy some bonds and to rebalance your portfolio, particularly with high valuations. I don't think they're going to go up in perpetuity. I think eventually they will reverse down because we're headed towards a recession, potentially if they stay high enough for longer, because that's how the cycle works. But I think it's something to really watch here. And I've always said interest rates are going to break out one way or the other. We'll talk about the chart here on the YouTube. If they break out higher, I think we can manage that. I just always worry about interest rates going to the floor, because then that's going to be the indication we're headed towards a recession. And given where the valuations are at in the stock market today, and we have a chart showing you how much this market has rallied this year. We'll get into it. That could be pretty violent.
Oil is back up above, it's pushing 90 today, as a matter of fact, on the Brent, and 80 something on the crude, so WTI. So it's come way back up from where it was just 2-3 weeks ago when it was $70 a barrel. So it's going to be a problem. Politically, it's a problem. Economically, it's a problem. How we get out of this mess, I don't know how it's going to work out. Interest rates basically flat last week from 4.56 to 4.55. No real change in interest rates, but they're not coming down. Even though we had good news on inflation, the CPI came in lower than expected, and that should have put downward pressure on rates. But market is saying, no, we don't believe inflation's coming down. As a matter of fact, with oil prices coming right back up, we could see inflation again in the next couple of months, coming right back up again.
Yeah.
Oil, this is an interesting chart.
Yep.
Where we're seeing, it was this purple line right here is semiconductor, and their cash flow was going crazy, and is going crazy now. But this is what was going on with the hyperscalers, and look at what is happening to their cash flow. Their cash flow is coming down, and these are the chip companies. Basically, the chip companies had taken over all of their cash flow.
Yeah, so once again, for our podcast listeners, if you go to YouTube, you can definitely see this chart. But basically, it's just two lines intersecting. One's going straight up, one's going straight down. The one that's going, the lines are showing cash flow. And basically, hyperscalers, Amazon, Google, Meta, Microsoft, Oracle, the ones that are really investing a ton in AI infrastructure build out, they've been making oodles of money of free cash flow for the past 15 years, and that's by the green line. But in the last, let's say, 2-3 years, as the AI investment has really scaled up, their cash flow is now negative if you look at them combined. And where is all that money going? Well, it's all going into these semiconductor companies, because there's a, NVIDIA, Micron, Broadcom, AMAT. It's because they're the ones they need all of these chips to build out the AI, right? Because AI is ultimately is a computing type of resource, and so that's all being fueled by chips. I think the thing is that the semiconductor industry is incredibly cyclical. We are seeing like the mother of cyclicality, and we've never seen this amount of cyclical move or demand. And I think some of it is definitely justified, because AI is revolutionary. I think as we look at it more and more, and the impact it's going to have on jobs and humanity and employment is going to be massive. And we don't know if that's going to be good or bad for the stock market. So far, it's been good for the stock market. We'll see long term. But I think whenever you get these huge run-ups in a short amount of time, you have to be very cautious, particularly with because what happens is they build all this supply, and then they come out and they say, oh, wait, we can now do it for half the energy cost because we've made it more efficient, and we have all now this excess supply that we've created, and then the things just plummet, and basically semiconductor companies don't have to make another chip for the next 5 years because there's enough AI capacity going forward. So I think the key takeaway is that the Magnificent Seven, right? Magnificent.
The hyperscalers.
The hyperscalers, how wonderful these companies are. Well, they were magnificent because they had oodles of cash flow. They don't have that anymore. And that's another reason why we're seeing them have not performed as much as the rest of the stock market so far this year. And so if you continue to double down on those trades that used to work, because these companies are having just ridiculously high cash flow and continuing to grow that over a period of time, but they're making the biggest of cyclical bets that we've ever seen in history on the AI build out. And that's fine. It's just then they need to, as you said, get a return on investment of that cash flow relatively soon.
That's the thing. Hyperscalers have put all their money into AI. And now we have to see a return on all of that money that they've invested in AI. So
and we'll find out.
We'll find out. And that's why people are getting a little bit nervous with the Mac 7.
And I just think, I don't know if the hype ever lives up to the reality. So I think that's also why we've been just kind of saying diversification is definitely your friend at this stage in the game. Doesn't mean you can't have some of the semiconductor chips and the hyperscalers, but don't have 50, 60, 70% of your portfolio.
This is the best chart I've seen in a long, long time. It goes back
because it's so good.
It is. It's a great chart, and it goes back 5 years.
This chart goes back to, it's averaging out the last 4 years, but the data that it's representing is going back to 1928.
Nearly 100 years.
100 years worth of data.
So it's looked at the market for 100 years, and it's showing you the top 10%, top decile.
Well, it's showing 4-year cycles.
4-year cycle, the top decile. When has the market made the most money in any 4-year period, going back to nearly 100 years, 98 years to be exact. The top is right here. And for all of you, if you don't go to YouTube, just go to the YouTube channel to look at this chart. This is the top the market has done, the best, the very best. Top 10%.
Top 10%, top decile. On average, for over a 4-year period, market's up anywhere between 60 to 70%.
The top 25% 6% top
Yeah, around 60%, maybe a little
return
less.
over 4 years.
Median, around 25, 30% is the rally we see. Really good rallies is what we see over a 4-year period.
And the current 4-year
Current, where we sit today, as you're listening on July 20th, 2026, the rally has been up to almost 100%. So we are in, when you talk about your statistic classes, we're in that very tail end type of returns. Now it's wonderful. We love tail end returns when it's to the upside. It's mean that we made a lot of money, but given relative to history, can it last? And I think, I'm not saying there's a bearish, we're saying just because things have gone up a lot, they can't continue to go up. It's just you have to be very, very, I think, diligent and not get caught up in all of the hype, because usually there is some reversion to the mean, and that's what we're monitoring, I think, really
There's
closely.
always reversion to the mean, as I look at it. As I've looked at it over the last 50 years, 40-some years that I've done this, everything comes back to the mean. When we get way away, 3-4 standard deviations away from the norm, that's usually when you have to, not that we're seeing the market as topping out right now, but this is the best 4-year return that we've seen in nearly 100 years in the market.
Yeah, and this is why you invest. You hope you get these type of returns, and they've happened. So it's nothing to be, I think, worried about. Hopefully you've benefited from it. I'm sure you have as Market Wrap listeners. But it's not about where you've been, but it's where you're going at this stage, because we're always thinking about what are the decisions we need to make today and tomorrow and the next day, not thinking about just, okay, it's been great in the past, it's just going to continue going forward. So I just think it's a really kind of puts things in perspective. And I think when things are at these type of top docile, very tail end type of moves in the market, the biggest thing that's going to help you kind of understand them is perspective of how it's looking and how does it shape up relative to history. And when things get, I think, a little bit too good, then it's just time to make sure that you're kind of prepared for whatever might be coming.
Folks, what I've said to you for 30 years, if you've listened to the radio broadcast and now you're listening to the podcast or the YouTube channel, it's not what you make, it's what you keep that counts in the long term. That's why we want to keep everything in perspective. That's why we talk about having a balanced portfolio. Anybody who gets unbalanced gets tipped over and you end up falling on your face. That's the thing that you have to be very, very concerned about. So do you have the right balance in your portfolio or not? Give us a call. We'll be more than happy to do an evaluation on your portfolio. Send us an email at invest@compact.com or just call us at 800-388-9700. Looking at the CPI numbers, sharply CPI cooled, 3.5% year. Core ticked lower to 2.6%. Retail sales also down. That's not good. Down 0.2. Not a lot.
Not a lot, but definitely the consumer, I think, is starting to feel it. And right now we're in the blackout period for the Fed. The Fed meetings next week. They're not raising rates. They're not cutting rates. I think they just got to kind of, especially now with the situation in Iran, coming back to the forefront, oil prices going back up. I know the president was talking about great cuts and, we need to be cutting and cutting and cutting. Yet, inflation now has been running above the 2% target for 5 years. So I don't know how you can be cutting rates when you're running already above your target here for 5 years. But at the same time, I don't think they're going to raise rates. You said they might potentially do some quantitative tightening, which means that, and right now I was looking at the proxy rate. So the proxy rate is taking the Fed funds rate plus a lot of whether we're doing quantitative easing or tightening. It's actually running above the current Fed funds rate. So the market is somewhat, the monetary policy is not, I would say, loose. I would say it's probably break even to slightly tight.
Right.
And if you look at the money supply is also running, how much money is the government creating? That's what ultimately created the inflation back in the post-COVID. It's only running around 4.7% annualized, whereas traditionally it's ran, we've increased the money supply by 6%. So the amount that the government is creating and putting into the system is still below what they've traditionally created over a period of time.
So we don't have a loose monetary policy right
No,
now.
that's
pretty tight.
I think it's pretty tight, and so that's why I'm not really afraid of interest rates, systematically going, higher. I think interest rates can go higher if we have these flare-ups in the Middle East.
Right.
But I don't think we're going, much beyond, hopefully 5% on the 10-year.
Not a lot of data coming out this week.
It's all about earnings.
It's all about earnings, folks, and that's what the market is about right now. It's all about earnings. We have great valuations. The market is valued pretty rich right now, and they're betting on these earnings. And earnings have been
Great.
much better than expected. Everybody said they're going to top out somewhere around 10%. We're at 16% earnings.
On profit margins.
Yeah, exactly.
I remember Goldman 4 or 5 years ago said, it's at 11%, profit margins are 11%. They can't go any higher. That's the end of it. We're sitting at 16 today. So companies are making more money than ever. Whether that's translating into the rest of the economy, I don't know. We're kind of seeing, particularly within tech, there's been a lot of layoffs, but I think a lot of that was overhiring during post-COVID. So we got to continue to just really watch the economy really closely, and that's why I like my high yield chart, which we always save the best for last here on market.
Looking at technicals, again, looked like we came up, tried to make a new high on the S&P, did not make a new all-time high. We sort of backed off from there. Now we're below the 50-day, below the 20-day moving average. So we could be just bouncing around here for a while. The fourth waves, this is the fourth wave right here. Usually they are choppy. Now we still have a little chance that we could go out and make a new high and get close to that 7,700 or number, or maybe a little bit higher. But if we start breaking down much below 7,300, then I think the market is in trouble. We're at 74 and change. That's where we are today, 74 and a half. See, the fifth wave also right here looks like it's topped out, but again, it could bounce around here, and we could make a new high, and the fifth could come here again if we come and make a new high.
Yeah, I think it's going to be tough now with interest rates kind of headed higher. It just raises the bar on earnings. And if the Iranian situation is not going away anytime soon, we were getting a lot of relief, right? Everyone's like, okay, great. Now interest rates are going to come back down, and so the valuations are a little bit more, tangible. I mean, a little bit more not as speculative as interest rates come down. Those earnings don't look as expensive. But now that interest rates are kind of seem to maybe we're stuck in this range, slightly higher. It's just kind of, I think that's going to be a big headwind for the market heading much higher. Unless we continue to just get great earnings.
Gap down on Friday on the NASDAQ, came back today a little bit, but then dropped back down again. Sort of just going back and forth. Again, fourth wave, typically back and forth, waves around. Hopefully we can come in, make a new high, get above here, get somewhere around 27.5. But we're at 25.5 today on the NASDAQ, 20,500. Same picture on the weekly charts on the NASDAQ. Sitting at the 20-week moving average. Came and kissed that a couple of times over the last couple of months, bounced off of it. As long as we're above 25,000, we're okay. If we break below that, 23.6 becomes the next target on the Dow.
So that's, I think, we're hoping that this is just a consolidation, right? We've now gone nowhere since kind of middle of May. When do you, and then hopefully we're recharging the batteries to new highs.
Right.
When do you start to get a little concerned that maybe that was the fifth wave top, there's no new highs, and things start to kind of break down? The dot plot?
Dot plot. I think if you get below 23.5, then the dot plot turns negative also.
On the NASDAQ, on the downside.
On the downside, and that I think will make it very difficult for the rest of the market.
Do we have a dot plot on the S&P?
We don't have the dot plot. I'll put it out there next week.
Let's look at that as well. Just because I know the NASDAQ, it's kind of leading to the downside, yet we're seeing this rotation. Right. So it's like the NASDAQ hasn't looked great for, it's done
3 months.
2-3 months, but as long as it's a rotation, then S&P is not going to go down a ton. Right. But if it's more of a risk-off signal, we're probably also going to see it on the S&P. So we can apply the dot plot to the S&P as well.
That's true. We will do that.
Stay tuned next week.
Next week, we'll put that out on the YouTube channel, the weekly charts for the small cap. It's not looking as bad, but I think coming down to the 20-day moving average wouldn't be surprising. It's not a big correction, but it would pull back a little bit.
Yeah, I think small cap, it's just things have really broadened out. I think as people have maybe rebalanced and getting more diversification, they've looked at international, they've looked at small cap, and that's kind of driving some of the upward movement there within small cap, which is, I think, still very positive.
International sitting right at its 20-day moving average. That's where we are, our 20-week moving average. If we break below that, then we could see a little bit more down to the 87, which would not surprise me on this chart at all. Oil looks like it's starting a new wave to the upside.
Yikes.
That's not good. I mean, came all the way down, got close to the 200-day moving average, broke above that, broke above the 20-day. Now we're above the 50-day, and looks like new all-time highs.
All-time highs in oil?
That's the way it's pointing now, at least a test of the highs, which was $120 a barrel.
Yeah, so that's I said, anything, this is, once again, we're looking at the DBO chart, which is looking at futures, so not only the spot price of oil, but also oil prices over the next couple of months. So anything above 19 means the conflict is definitely still alive and well. And then particularly, I think we get above 21.50, that's when things are really getting pretty touch and go in terms of how bad the situation was going to be. So if you're talking about getting back up to those May highs, that'd be 23 and a half. And then I think, you're going to see interest rates go higher.
And the stock market pull back?
Yeah, I think the stock market can pull back, and but I still feel like it's not the end. It's not the beginning of the end, because I don't know how much oil really plays into the whole AI investment theme.
But you never know. When you get into wars, you never know which way they're going to go, how they're going to expand, and what happens. And those are all the unknown unknowns, as Rumsfeld used to say. Weekly chart, again, above the 20-week moving average now. We came down close to, got a fourth wave correction, and it looks like a fifth wave. Doesn't look like on the weeklies, doesn't look like we're going to
Not as strong.
Not as strong. Does not seem like it's.
That's kind of how I feel. I think one of the, it's a saving grace if you're in China listening to this podcast, which I don't know how many Chinese listeners we have, but the Chinese economy has been pretty weak. And so that's really kind of curtailed a lot of demand for oil. So even though we've lopped off 20% of supply by closing down the Strait of Hormuz, demand for oil has really kind of come down in line with that supply. So, and I don't know if China's reaccelerating anytime soon if we continue to see kind of.
One thing that caught my eye today, and nobody has really been talking about it. Everybody talked about the Straits of Hormuz, but we saw most of the Saudi oil production, shift to the Red Sea. They've got pipelines.
Yeah.
And that was still coming, that oil was still coming and sort of offset all of the oil that was not coming through the strait. It was coming to the Straits of Hudad or Habab, as they call it, through the Yemeni coast. But the problem is there's another choke point there, which is exactly like the Straits of Hormuz. And today Yemen announced that it's putting an embargo on that. That they're going to shut that down.
Because you have the Houthis, right?
The Houthis, that's Yemen. And the Houthis came out and said they're going to shut down the Straits of Hormuz, Strait of Hudad, as it's called. And it's a problem.
If they shut down both straits, basically Saudi Arabia's exports
go to zero.
Yeah.
And that's where they're still shipping, I think, 5 million barrels a day or some crazy, really large amount.
So I think that's, Strait of Hormuz is kind of off the table, at least for the time being, unless, we just send them a bunch of money. But I think that's the other thing that the markets, if they shut down the other strait, then, oil prices go to the moon and interest rates go to the moon, and, you're going to see a pretty big, tangible correction. And then the question is how long they can keep that shut. If the pain gets too high, then they might actually say, hey, we actually have to go in and take these guys out because we just can't, we're not going to be able to structure a deal. But then that's, to your point, the whole situation has escalated.
It's exploded, and that's what happened. And that creates a whole mess. It blows up the whole Middle East. And Saudi Arabia starts going and attacking Yemen. We start going in and backing, to have to take out. And then what are the Europeans going to do? Because they're much more dependent on the oil coming from the Middle East. And what does Asia do? It's just a big mess out there. So we don't know exactly. But right now, it's sort of a balancing act right now. And that's why I think the market is sort of biding time to see which way this camel sits, as the old saying goes, in the Middle East. So we're looking at treasuries. It's sitting right here, but it's right back up, getting close to the highs. We get much above 4.85.
Yeah, 4.7. Yeah,
seven.
we made that high. That was middle of May.
Yeah, we get above that. That could not be good for the market. And then we're pushing 5% or so, or 4.
But once again, I think if interest rates go higher, the market can pull back. But I think the key thing to watch is whether that's going to start to filter into the bond market credit spreads.
Right.
You know, are we starting to see high yield bonds, or is this kind of more of just interest rates going higher because there's kind of temporary inflation or
Fears,
slightly
yeah.
higher inflation just because oil is becoming more expensive, right? So that's going to raise costs of everything because oil touches basically everything in terms of transportation costs. So I think that's, you know,
I think that'll show up if you start seeing the spreads change and the spread between the HYG and the Treasury start going. That will show us that there's structural damage starting to happen to the economies of
which
the world.
I would say there's not structural damage yet.
That's exactly.
We have the ingredients, and so we're going to monitor that really closely. But it's something that we got to watch very closely here going forward. And here's the chart right here.
Here's the chart on the relative trend. You see interest rates. You know, this HYG has come AGG has come down a lot.
Yeah, since the beginning of July. Yeah,
since the beginning. But we see this right here. That's the HYG, which is high yield bonds. They've just sort of gone sideways. So they're not really, high yield bonds start to go down when the economy starts to slow down. And it's showing that the economy is not being hurt yet. We're seeing interest rates have gone up because inflation expectations have gone back up.
Yep.
But it's not showing damage to the economy yet, as I'd like to emphasize that. But if this starts to break down, the HYG also starts to break down, like we did see in March.
Well, but back in March too, I wasn't as concerned because HYG was coming down, but AGG was coming down as well. Where you're going to see is the risk off, where I think we could get temporarily, we get higher interest rates, right? And just because oil prices spike. But then very quickly, the market's going to say, okay, wow, this is now going to start to cause some structural damage. Interest rates are going to reverse down.
Right.
And so then AGG is going to go up, but HYG is also going to go down. That's the signal we're kind of watching at. Well, I look at it every day. And you'll hear it us here on Market Wrap if that starts to happen. That's going to be your time to make sure that you got all your ducks in a row, your diversifications in place, because now potentially we could be having a bigger correction.
I know, folks, we're talking about a lot of technical stuff here where we're talking about HYG and AGG and the spread between them and all of that. If you are concerned about, you don't understand a lot of what we're talking about, feel free to call us. We'll be more than happy to explain it and how this is going to impact you, your financial future, your portfolio, and how it's going to affect you financially. We'll simplify it for you. Give us a call or just send us an email at invest@compact.com or give us a call at 800-388-9700. We'll be more than happy to sit down with you, make an appointment, come into the office. The evaluation is free. There's no cost or obligation. And you can subscribe to the YouTube channel. All the charts we've talked about there. And go to compact.com/YouTube. Go to compact.com. Click on Insights. All of it is there. Give us a call. Come by the office. Those are our thoughts. Those are observations for this week. We will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.